Well, I usually do this a lot easier. I sit in a studio, I've got a camera, bright lights, and I say, hello everybody, welcome to Ask the Property Experts. My name is Kura Chiota, and I don't have 200 faces looking at me, making sure I don't stuff up. But I'm going to do the program live. Scott, if I can ask you to come and join me. I'm going to ask Jacques to come up, Neil to come up as my panelists. Mr. Dolf Durus, Doctor, Honorable. I've got a pain in my back, eh? That's a good sprint.
Oh, yes.
Now you can just talk to your guys down in Oz in Kiwi and not make them tackle so hard as well.
Oh, okay.
All right, we have the panelists up front. I never purport to have all of the greatest questions, but the show is called Ask the Property Experts. So the experts are with us here. Can I take some questions from the floor for our panelists?
My question is towards Dr. De Roos. Doctor, I'd just like to ask your take on this. I'm in a position where I'm able to buy commercial properties at quite low prices most of the times, at least half of what the banks conservatively value them after I bought them. So I'm sort of at a stage where I'm just trying to get a feel for how do you go to a certain level where I can do deals. I'm currently getting deals that's 10 and 20 times bigger than what I can chunk off. I'm just sort of curious to find out how do you go about getting those right partners. I've got a lot of people wanting to come in, but obviously going with the right people I think is critical. I just think you've got a lot of experience in sort of, just getting with the right people that you enjoy working with and that you can do it with.
Well, I'm going to sit with you at lunch, then we're going to chat with Jacques, and we're going to list, and we're going to be sorted.
That solved it. Are you suggesting that you can buy them at below market value?
That's correct, yes. Normally the price that I buy them at, the commercial properties, the bank in general value them at least double than what I'm buying them from after I've tenanted and fixed up and stuff like that. Yeah.
So what value are they using for them to determine how much they'll lend you? Do they take the lesser of the purchase price or their valuation?
Well, that's negotiable. It differs from deal to deal, but banks here like to do based on purchase price. But we do get them sometimes based on market value. So.
All right, because the trick is to figure out how to get them to value it at market value. Yeah. Because then you can get a 50% loan based on market value and it's your entire purchase price. Okay. And if they won't do that, I'll buy it first, I'll sell it to you for double the price, which is the true market value. And no, I mean, this is the way it works in the real world. So I'm curious, and we don't need to go into it now, but how come you can get them at half the true value? Or why would banks value them at double? Usually they're so conservative. They send in their 85-year-old ultra-conservative valuers, and they say, well, no, because they've got this history of thinking inflation can't have been as big as it's been. And they tell you that's just the way it is. So, I mean, if that's a formula you've cracked, I'd go for it and buy as many as you can. And at that point, any good partner, I mean, if you've got 100 offering to give you the money, take the better one. But anyone who comes up with the money is good. It's like, which bank should I go to? It doesn't matter. They just provide the finance. One is as good as the other. If you've got that formula cracked, I'd just get as many as you can.
So you'll be behind me when I'm sitting next to him at lunch. I'm talking to him first.
Okay. I'll sit on the other side.
Yeah.
I just think he's done a form of crowdfunding every year.
Yeah, I've got a question towards the back of the room. There's a gentleman there. Yeah, but in the South African loan agreements, I've heard of those three ugly words: the lower of market value, or the loan to values of market value or offer price. They covered themselves on that.
Yeah, thank you. I have a very simple question. I'm fortunate enough that on 1 December I will be in San Diego myself. Would there be a possibility to see the property, the retirement home, with regard to the crowdfunding concept?
So basically, what our the best thing we can possibly say is get on the ground, come on the ground. So our whole business model is complete transparency. So 100%. If you're coming to America, if you're coming to Australia, if you're coming to England, come meet with the partners. If you come into Bloemfontein, if you don't know where that is, we'll point it out to you on a map.
Yeah.
But yes, the answer is you're 100% you can come and see the properties, meet the partners on the ground. The best thing to do, though, with all due respect, is if you're going over and you're going on holiday, you're often not in the right mindset. You want to spend time with your family, have a holiday. The best thing you can do, and I know Neil and Dolph, and we've all done it, is to take a week of your life, come over when we're going over. I mean, I know, Michael, you've been over, and there's other people in the room that have done it. And invest a week of your life in your future and do it properly, meet all the partners in a systematic and organized way. And, like Yanni Muller did, you're with other sophisticated investors, and you believe it or not, you've got good questions, they've got good questions, and you make magic together.
Sure, but all I'm saying is I will be in San Diego, and you guys are not going to San Diego.
Well, look, I mean, we don't, at the moment, I don't know, Dolph, we're not investing in San Diego.
I understood
other than the one you were talking about, the resident, the old Ashram, but...
Yeah,
I mean,
well,
look, the bottom line is...
basically 5 kilometers away from it, so 10 kilometers. Laguardia is part of San Diego, so I thought maybe I could see it at the same time. That's what I'm
Yeah,
saying.
you're going to San Diego. You want to see other opportunities.
We're talking about the example. Yeah, I was just listening.
All right, if it's the retirement complex in San Diego, personally, I wouldn't need to go there to see it. I used to walk there every day, I know it, but I wouldn't need to see it. With those 3 factors, it's by the beach, it's a retirement complex catering to what's now the increasing proportion of the population, and it's in a great suburb. As long as you're not paying over market for it, you're going to do well. But here's another differentiation point between crowd-funded real estate and real estate agent-provided real estate. The real estate agents tend to have great marketing arms and fantastic photographers and all that, and they'll make it look very good. They can make anything look good, which is good. I'm not criticizing them for that. But crowd-funded means we've got that social proofing again. And everything I've bought on eBay, and I'm sort of active on eBay in a number of different sectors, I don't need to see it. I don't need to see the seller because they provide me 5 or 10 or 20 photos from different perspectives. And it's the same with crowd-funded real estate. If we make photos with wide-angle lenses and digital enhancement to make the properties look better than they are, word would soon get out. But if we just show it the way it is, because this property is good on its own merits, at the end of the day, do the numbers work? So I think crowdfunding has that extra layer of benefit that you can't hoodwink people, to use a polite term. All right? So it's just easier to figure out.
Just to clarify on your question, we're not currently investing in that specific opportunity. Dolph was just saying that as a long-term trend, that's a good one. And I can tell you categorically why we're not investing there. We've broken one leg of the table, the 4 legs. We don't have a good partner on the ground there. We've got no one that we can trust to execute. There's millions of opportunities all over the world. If you don't have a good partner, you will not be able to execute on it, guaranteed. And so until we can find a partner, we can go to Lake Tahoe, we can go there all the time. But the point is, we need a guy on the ground that can find the opportunity, uncover, execute, and most importantly, sweat the asset once we own it.
Thank you. Can I ask you to take up your further questions with them over lunch? I've got a question from a young lady on the right, and welcome to the right-hand side of the room.
Thank you. In terms of the time frame of investment, how long would you invest in a crowdfunding scheme for? Should you wish to get out, how much would you get out of your original investment, or are you locked in long term?
I'll hand it over to Scott, but just to repeat it for those who couldn't hear it, in terms of the duration of investment, how long would you want to invest? How long would you want your money in before you want to see it pulled out? Is that in essence the question?
Yeah. I mean, I think in simple terms, the way that we've done it is we've got 2 umbrellas. We've got what's called an income and we've got a growth. The growth is where it's slightly more aggressive. It might be that stuff in North Dakota where it's factual, we're building, it's development. It generally has a 2-year window frame on capital with payments due out as per project. Because remember, this is not, you're not putting your money in across multiple projects. It's one project, you know what you're putting your money in, it's black and white, just as if you and me were doing it together on our own. And then we've got the income, which is generally a 5-year hold. It's more existing buildings like the medical portfolio or the residential properties, and it's quarterly dividends paid out.
Thank you. I've got a question right at the back of the room. Let's take that one, and then come to the young man at the front here.
Hi, just from the Neil's presentation, we want to know a little bit more about the rent-to-buy concept.
Okay, this it stems essentially from the ALA, the Alienation of Land Act, which is an act which came around in 1963, where essentially you can put in an offer on a piece of real estate from a contractual point of view. So if there's an owner that's in distress, You can go to and do a direct contract with them. You can leave those people essentially in their existing property, and you could make an offer, a today offer, so you can get today's market value price, and the property could be valued a lot more. Some of the advantages of that is that obviously, the person that actually owns the current property, the whole idea is to try and keep them in there and not to evict them out and get rid of them. We heard a lot about that today, because some people, trouble happens, economies get bad, all that kind of stuff, and we have this thing about, so it's another way where there's a win-win scenario over there. So rent to buy is taking it one step further. I know we've got an expert in the room. Where's Mayor? Mayor here. Yeah, Mayor's at the back. He can elaborate, but I think that's also a lunchtime conversation. But essentially it stems back from the ALA concept, and it's one step ahead on that. I know in the US, Dolph, you want to maybe comment on that. Is it a similar type thing in the US?
I try and simplify the concept a bit. You can sell a property outright and the buyer then owns it, or you can rent it to them and they've got the right to buy it in the future, either at a fixed price or at a price yet to be determined. And in the States, 98% of rent-to-own contracts result in the tenant not acquiring the property. So it's kind of a good thing to do because you extract an option fee from them. It gives them the right, but not the obligation to buy it in the future. But you can get caught out. We did 52 homes once in Las Vegas. 33 of them were rent-to-owns, and every one of them purchased because the market went up so incredibly great that even if they couldn't afford to buy them, they could sell the houses for even more than they'd contracted with us to buy them. So there are advantages. I'm a believer that if you're for real estate, do it for the long haul, own it forever. Never sell, basically. So I don't understand the concept of offering a rent to buy, because if the tenant exercises their option to buy it, you don't own it anymore. You've got to find a new one. That's work.
Sure. My late friend and mentor, Ian Fife, always used to say, why go through all the world to meet a wonderful woman, romance her, fall in love, only to divorce her the next day? Marry it. Marry the property. Marry the property. Okay, I've got a question up front here.
It's a question for Scott. Just I'm looking at your opportunities fact sheet and the Bloemfontein property in particular. Can you just flesh out some of the detail on that? It says 343 million rand total project cost with equity of 13 million, but you're going to phase it. So clearly, 3 phases. So it could be 100 million each or whatever. But it just looks like very little equity for a development of that size.
No, 100%. Look, it's a structured deal. Has anyone been to Bloemfontein recently? Okay, so if you don't know what's happening in Bloemfontein, effectively the new Sandton, the new four-ways, if you just imagine four-ways, Monte Casino and everything, it's happening out towards the N1 and there's a whole new node that's taking place there. And that's an office park development. The land's secured, it's a phased project. And in simple terms, we're buying the land for 13 million. It's getting serviced. I think Yaku's at the back there and Michiel's outside in terms of the technical detail, but it's getting serviced. I know that all in, we'll be in for about $20 million, and there's already a valuation from the bank for $44 million. 44 million rand, sorry, I think in dollars. So in simple terms, and then from there, we've already got the building partially let. There's a whole feasibility that we've got outside if you want to look at it. But just like everything else, it's complete transparency, and the number one thing that we've achieved there, which we always do, is we've got partners on the ground that are only participating in the back end, not the front end. No one's earning fees in the process.
Good. Thank you. I've got a question here.
If you want to get out of this, the crowd, if you want to get out of the crowd investment, how does that work? So you're in the investment, you start, and then you want to leave it.
Look, to be honest, it's not, at the moment where the market is at the moment, it's not too dissimilar to you and me deciding we're going to buy a house together. We agree we're going to hold the house for 5 years, and then in 5 years we make a decision as to how we're going to exit. There is actually one of the most exciting things, which I didn't have time to tell you, but one of the things that's going to change the rules of the game is there is actually a secondary market coming into place. There's a big company that actually manages and underwrites and has the facilities for 85% of the world's REITs. They've got over 100 million clients. And they're looking to create a backbone for a secondary market for people to be able to move. So ultimately, the best advantage or the worst problem with fixed property is liquidity. and this will actually provide with the liquidity. But at the moment, in simple ways, there's no better way to describe it other than 2 friends, 4 friends, whatever it is, getting into a deal, agreeing what the window time frame is. But then the way we've set it up is from an investor mindset. You know, I know someone personally, there were 4 friends that bought a great building in London, and their 5-year window period came into being in October 2008. And even though it was a terrible time to sell, they were forced to sell the property. So it's got a whole lot of protections in it, so that with an investment mindset, we investors can invest together.
Thanks.
Does that answer your question?
Kind of.
Depends on the project. In simple terms, 2 or 5 years, depending on the project.
I'm just talking, say, for instance, in a hospital, and you know, things happen, and you're now in a situation that you need that money out, or that money out of that asset. And it's not on a contract or a timeline or anything.
At the moment, well, there's a contract. There's a contract for 5 years. So at the moment, you're in the deal, that particular deal for 5 years. I'm sure you might be able to find a friend or family to be able to take you out, but we don't guarantee some sort of liquidity or tradable market.
It's not guaranteed, but usually there are rules in these things, and if you have some need to get out, there are rules as to how you can do that. Firstly, you'd have to offer it to other investors in that group first before you go to outside parties. And those rules get changed and modified as time goes on, as we learn more about it. But there are mechanisms to get out if you're in need, absolutely.
The thing with crowdfunding, guys, it's not a new rocket science you've never heard of before. It's 80 to 90% of what you're used to. It's just technology enhancing it. And the one thing I didn't say is that the biggest risk we have in crowdfunding is that there is going to be a spectacular crash in the next 5 to 10 years. I don't know when it's going to happen. Because we heard just 2 weeks ago, there's over 1,000 real estate crowdfunding sites worldwide right now. Dolph and I were 2 months ago in New York. It's a bunch of young 20-year-olds that are IT people that are building sites. They use fancy terms like curatorship. Does anyone here know what curatorship is? Okay, well, us property people just call it due diligence. And they try and use fancy terms. And the bottom line is, just like when the .com, boom, bust, whatever, the Googles, the Facebooks, the Amazon will prevail. But you need to understand that you want to deal with property people that understand technology, not IT people looking for the next opportunity.
Great. Thank you. Can I get any further questions? Last question from the gentleman at the back. I feel maybe I'm at an auction. Here we go. We're coming in with the gentleman with the question at the back. Before I release the panel, the one with the long hair is going for the most money.
Hi. Probably a question for Dr. De Roos or Scott. In 2001, South Africa faced similar uncertainties, and the currency then strengthened to unprecedented levels. And we also saw one of the biggest bull markets on share portfolios and properties, and people then got burnt around about 2008, 2009. What makes 2013 and 14 different from that phase? Sorry, just one more question. Who are the auditors of Wealth Migrate?
God thought it. But do I answer the first question, Bob?
There are always short-term cycles and there's the long-term trend. And the philosophy I try to adhere to is you should never work on short-term cycles. You shouldn't buy in the expectation that it's going to go down or hedge your bets that way, or buy in the expectation that in the next 2 years it's going to go up and then you sell. If you look for short-term gains and profits, it's essentially what many people on the share market do, not all, but many, then you have to be trading it all the time. But if you're in it for the long haul, if you invest in areas where there's an increase in population, because we all know there's a very strong correlation between population growth and capital value growth, then you will get dips. The dip in America was the biggest in history in real terms, and even in absolute terms, even in real terms, it was proportionally one of the biggest dips we've had, but we've had one of the fastest recoveries too. So if you're in it for the long haul, then you can ride through those trends. Remember, you're not using your own capital in many cases. You're sourcing bank capital or third-party capital, so you're leveraged in that sense. We all know that means your downturns are also leveraged. If you buy just before a crash, you're in some serious trouble. But if you buy not everything on one day and hope that you're not just before the crash, but you've been buying a property here and a property there, and you do it over a period of 5 or 10 years, then you will ride through those waves. So I hear your question, what's going to happen short term? have a bit of spread. Some people spread themselves ad infinitum. They buy a few shares and a few options and a few futures contracts and a little bit of real estate and some candy and some goodness knows what. I believe in being spread, but in real estate. So I'm in real estate, I'm largely in commercial, and then you want a geographic spread because the world is going global, and I wouldn't put all my eggs in one basket. Anyone who does, I think, is foolish, and America's very much to blame. This. Not only are American individuals completely within America, I think fewer than 1% even think in terms of doing anything overseas. They don't know what other currencies mean. They don't know that they have different colors and sizes for the different notes. So be geographically spread, have a spread amongst currencies, and then you're almost immune from that. As one goes down, you've still got 6 others that are going up.
Okay. I heard eggs, I heard baskets, I heard spread. It's lunchtime. I'm going to ask the following. The ASAQS members, the quantity surveyors, or brick counters as I affectionately refer to them, Herman Bosman, Shahid Isop, Lucius Snell, Timothy Smith, Sherry Smith, and Villy Viljoen, to see the ever-lovely Lynette at the front to get your CPD certificates for attending. Lunch is served at the restaurant just out the way. My best impression is out the doors, to the left. We do have kosher and halal meals for those dietary requirements, but we'll see you back here in about 40 minutes. Thank you.